Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters for making this video possible, and we would also greatly appreciate if you consider supporting us as well, so please check the link in the description for more details. My name is Sava, and today we're going to investigate a key concept in risk management and Basel Committee for Banking Supervision (BCBS) liquidity regulations, that is the liquidity coverage ratio that was introduced in Basel III at the aftermath of the global financial crisis of 2007-2008, and that has been phased in since 2014 and 2015 across Basel jurisdictions. The logic of the liquidity coverage ratio is to modify and improve the existing proxies of bank liquidity and to adjust for the quality of liquid assets that the bank can liquidate to provide for net cash outflows in a stress scenario, that is, whether there is a potential run on the bank or when the liquidity is tight and depositors might want to liquidate their holdings in a bank. So, as all Basel ratios of this nature, this liquidity coverage ratio heavily uses various weights, haircuts, exposure limits, and we'll go through them in one go today. The source of our data, the bank that we're calculating the liquidity coverage ratio for, is Barclays, and we're using the data for the 2019 annual report, available at the link here. The methodology for our liquidity coverage ratio calculations comes straight from Basel Committee for Banking Supervision 2019, the most up-to-date methodology for LCR calculations, and also, we are using this paper. This is a discussion paper by the European Central Bank, Hoyer et al., 2018, that investigates how one might calculate liquidity coverage ratios as an outsider when you have no access to internal banking disclosure, internal data, and use only publicly available data from banking reports. And we will see how closely can we match the actual liquidity coverage ratio reported by Barclays by our proxies with imperfect data available to us as outsiders. Obviously, that's the main problem with many of such ratios, that precisely calculating them involves knowing disaggregated data that can be only available to bank insiders, risk analysts, risk managers, and not reported to the general public. However, as we might see, we can use these two papers, the insights from those methodologies, to arrive at a good proxy. So without further ado, what is the logic of the liquidity coverage ratio? The logic is that the bank should hold enough HQLA, high-quality liquid assets, to provide for net cash outflows in a stress scenario, in a scenario when there are runs on banks and when a lot of deposits are being liquidated. Which assets can the bank sell, realize at a reasonable discount, reasonably quickly, to provide for these outflows? Well, Basel uses the distinction between level 1 assets and level 2 assets, further breaking them down into level 2A assets and level 2B assets. Level 1 assets are cash and balances at the central bank, which are very accessible, very liquid, and can be liquidated almost immediately to provide for these outflows. That's why these assets, level 1 assets, have no haircut in the LCR methodology, and they can go into high-quality liquid asset with a coefficient of 1. And we can see that as the liquidity coverage ratio is concerned with short-term liquidity, 30-day liquidity to be precise, and most banks report on-demand items in their contractual maturity of financial assets and liabilities disclosure. This section can go either as contractual maturity or maturity analysis of assets and liabilities. This should be available for any systemically important financial institution you're investigating. Well, here we can arrive at a 30-day proxy by adding up the value on demand and adding up the value that goes under not more than 3 months, and divided by 3. So this would be on demand plus those that mature in 1 month. And as there are 3 months in that period and we're interested only in 30 days, we can divide by 3. And again, this is a reasonable assumption to arrive at such a proxy. Then level 2 assets are the assets that can be liquidated at some cost. And because it's a stress scenario, a scenario when financial markets are distressed, when there is a liquidity crisis, you need to add into account reasonable haircuts, reasonable deductions from the current values of these assets. At which drawdowns would you be able to sell these assets to provide for outflows? And level 2A assets are generally high quality debt securities, which are high quality government, sovereign, or corporate debt. And these can be extracted from the trading portfolio and financial securities held at fair value sections of disclosure. Those come in Barclays from the section Assets and Liabilities Held at Fair Value, where they report the breakdown of their trading portfolio and the breakdown of their accounting for financial assets and liabilities held at fair value. And from those two disclosure items, we can extract debt security, so bonds, either corporate or government, get the 15% haircut, accounting for the fact that in a stress scenario, you could expect debt securities to drop 15% in value, especially if there is a fire sale, if you want to liquidate those quickly to provide for net cash outflows. So this is why here we multiply these by 0.85 and arrive at our adjusted high quality liquid assets item. Level 2B high quality liquid assets are assets that can be realized quite quickly, but that have higher drawdowns in a stress scenario, and that can be depressed in value to greater extent if there is a fire sale. And those are generally equity securities, and we extract them from the same source, from assets and liabilities held at fair value and from the trading portfolio of Barclays, and get those adjusted values. So basically we slash those by half to be reasonably conservative and state that, well, even in the worst case scenario, we would be able to sell equities that we hold at half of their current value. And then we can sum the total high quality liquid assets, our HQLA proxy, from level 1, level 2A, and level 2B. And here we need to account for the Basel restrictions into the composition of high quality liquid assets, namely that only 40% of your high quality liquid asset stock can be comprised of level 2 assets, both level 2A and level 2B, no more than 40% of the total stock. At least 60% should be high quality liquid assets level 1, so basically cash, and level 2B, to be precise, so equities mainly, must not account for more than 15% of total high quality liquid assets. That provides additional restrictions onto the composition of HQLA of a bank and makes sure that a large chunk of their liquidity buffer, of their liquidity pool, is realizable, is being able to liquidate at its current value, at the coefficient of 1 with no haircut. So how to account for this logic in the calculation of the total HQLA stock? Well, we need to check what is the minimum of the three values. Well, if all of these conditions are satisfied, then the total HQLA stock, the total liquidity pool, would be the sum of the three, the sum of level 1, level 2A, and level 2B. If it is the case that level 2A and level 2B correspond to more than 40% of total HQLA, then we would just need to divide our level 1 by 0.6. And if it is the case that level 2A and level 2B do provide less than 40%, but level 2B is overweighted, we can account for that by this particular adjustment, by adjusting our level 2A assets so that there is 40% of level 2 assets in total, and only 15%, so 15 and 25%, are level 2B and level 2A respectively. This adjustment makes sure that we comply with all of these additional regulations imposed by BCBS on our HQLA stock. And this is the numerator of our liquidity coverage ratio. So what goes into the denominator? The denominator represents the net cash outflows under the stress scenario. So the basic logic is that we have to calculate the inflows and outflows in the stress scenario and compare them to the high-quality liquid asset stock that can be used to provide for these outflows, to serve as a buffer. And the liquidity coverage ratio should be at least 100%. So at least all of the net cash inflows in a stress scenario can be compensated by the liquidity pool available to the bank. And the idea is that, first of all, we have to consider the deposit runoffs. How much of current deposits are to be liquidated under a stress scenario. And here, Basel again provides some reasonable proxies, some reasonable run-off rates. Run-off rates represent a proportion of a particular section, a particular group of deposits that would be liquidated in a stress scenario. Well, first of all, we get a total amount of deposits that are currently held by Barclays customers within Barclays. It represents 415 billion pounds. And we need to break it down by currency and by the customer group. First of all, the deposits from financial institutions, monetary or otherwise, are assumed to be totally liquidated in the stress scenario, with the runoff rate being 1. The assumption is that if there is a liquidity crunch, financial institutions would aim to liquidate their holdings in terms of deposits in other banks in full to provide for their own liquidity needs. That's quite realistic. So this runoff rate is 1. And how you might get this disclosure item, deposits from banks and financial institutions? Well, Barclays and many other systemically important financial institutions report this breakdown in the annual report section called Loans and Advances and Deposits at Amortized Costs. So here is the disclosure item that you might want to check. And if we subtract this item, deposits held by banks and financial institutions, that is subject to a runoff rate of 1, we get the deposits that are fully from either our commercial customers, so non-financial corporations, and consumers, so households. And these are subject to different runoff rates again. All commercial deposits, so deposits by companies, by corporations that are not financial, are subject to a runoff rate of 0.25. So we expect that under the liquidity crunch, under a stress scenario, 25% of our commercial deposits would be liquidated, would be taken out. And to see how many commercial deposits there are, we have to make some reasonable assumptions about the structure of our clients. And Barclays, in particular, provides this structure for their UK department and no structure like that for their group. But we can assume that the structure between personal and business deposits for Barclays is quite homogeneous across their departments, and use the UK structure and then impose it to the total group deposits. And here we can see that among the UK deposits, the business deposits, which are commercial deposits, deposits by non-financial corporations, account for 22.53% of total UK deposits. So we can impose this ratio onto the commercial and consumer deposits value we have just obtained by subtracting bank deposits, and get roughly 90 billion pounds. And applying the 0.25 runoff rate, we get that 22.5 billion of those would be taken out under a liquidity crunch. Then we are left with more than 300 billion pounds of consumer deposits. That's quite realistic. There are mostly customer deposits that banks are dealing with, and those we have to break down by their currency and by their region of domicile, because it is assumed by Barclays that domestic clients' deposits would be more stable than international clients' deposits. So foreign currency deposits are subject to a 0.1, 10% runoff rate, meaning that foreign customers would be more likely to withdraw their deposits under a liquidity stress scenario, and domestic customers would be less likely, with a runoff rate of 0.05, 5%. How you might arrive at this proxy? How to break down deposits by currency? Well, here we have got the total deposit structure for the group overall. And here we assume that the country structure, the location, the country of domicile of our clients is homogeneous across our personal and commercial clients. And that's, again, quite reasonable simply because Barclays is quite internationalized, mainly with operations in the UK and the US. So those international clients are mostly US clients, to be fair. And we can see that overall, roughly more than half of our clients are international, and we can extrapolate this onto our consumer deposits and get the value of 157 approximately billion pounds of international customer deposits, which would be subject to a runoff rate of 10%, getting 15.6 billion pounds of cash outflows. And half of that, so 0.05 or 5% runoff rate, would be applied to the remaining domestic deposits by households, which would take roughly 8 billion pounds from our bank in the stress liquidity crunch scenario. Then we need to account for other outflows, which would be all other liabilities apart from deposits. Here we actually assume, and this is quite heavily stressed by Basel and BCBS in particular, that we need to account for the fact that deposits, regardless of their maturity, can actually be terminated under the liquidity stress scenario, because generally in most jurisdictions there are no that heavy of penalties for premature cancellation of deposits. It's either impossible legally to refuse your customers to give them back their deposits, or it's just unconventional to do so. And at most, those customers would just lose interest on their deposits if they terminate them prematurely. So it's quite realistic to expect that under a stress scenario, depositors would still cancel their deposits to these extents, even if it means foregoing the upside in terms of potential interest. So we need to account now for liabilities that are maturing in a 30-day period with deposits taken out of the picture, as we already accounted for them in this deposit runoff scenario. And here we return back to the contractual maturity of assets and liabilities page in Barclays disclosure, and just subtract the deposits across the respective maturity bands from total liabilities and get other liabilities that are due on demand and in not more than 3 months. And then we use this quite simple proxy to get a 30-day value on demand plus a third of those that mature in 3 months. Again, this assumes that the maturity distribution of these other liabilities is uniform across 1, 2, and 3 months periods, but again, without any more data on this, it is quite realistic. And then we need to account for the potential inflows that we'll receive during the same 30-day period. The inflows that could potentially provide and cancel out the outflows that we would experience from deposit runoffs and from other liabilities that are just maturing in 30 days and we have to provide them. Well, here it is important to avoid double counting. You cannot include assets that are qualified as HQLA that are already calculated in the top here as the basis for your inflow calculations. And that is something that banks are not permitted to do, to artificially inflate the liquidity coverage ratio and double count items in their liquidity pool, in their HQLA, and in their inflows. So we only account for asset categories, those that mature in 30 days, so using the same proxy logic, but only account for assets that we were not considering for our HQLA calculations. And those are our settlement balances, our loans and advances, our repos, our derivative exposures in the asset category. The derivatives exposures in the liabilities category are accounted for here in other liabilities, and other financial assets, which are quite a minor disclosure group. And here we use the same logic of 30-day proxy being on demand plus not more than 3 months divided by 3, and we get expected inflows across all of these remaining asset categories. And now we can finally calculate and make sense of our inflows, outflows, and net outflows. So our outflows would be the sum of stress scenario outflows across deposit groups, subject to the runoff rates we were discussing, and the outflows from other liabilities unaccounted for in this calculation. That's quite straightforward. Then for the inflows, we need to account for inflows across all asset groups that were not considered for HQLA calculations, and then we need to calculate net inflows. And here it might be quite intuitive to say, well, it's just outflows minus inflows. Yeah, net outflows, net of inflows. However, here Basel again plays a little bit dirty and imposes some additional restrictions on banks to make this stress scenario assumption more realistic. Basel requires that inflows should not compensate more than 75% of outflows in the stress scenario. Basically meaning that you cannot just inflate your inflows and try to mitigate your LCR requirement that way. You need to also make sure that your inflows are not too high, which means that we need to calculate the maximum of the difference and the outflows times 0.25, which is basically outflows minus 75% of outflows. That's the most we can compensate for by our inflow calculations. And here we get 135 billion pounds in expected net inflows under the stress scenario. We can see here that this buffer, this restriction of 75% is actually not fulfilled, because just the difference of outflows and inflows is equal to 135 billion pounds. And here it means that Barclays accounts for the fact that it cannot really just inflate the inflows to make it seem that their liquidity is good. They have to make sure that their stock of HQLA, their liquidity pool, is large enough. And here we can finally calculate the liquidity coverage ratio with HQLA stock, liquidity pool in the numerator, and net outflows in the denominator, and get 169%, well above 100%, which is mandatory by Basel regulations as of now. And we can see that this figure is actually quite close to 160%, that is reported by Barclays itself in 2019 in its annual report. That signifies that such a proxy approach is quite accurate, and it leads to very close figures that are comparable to actual disclosure items, which makes such a methodology taken from Hoyer et al. And some insights from Basel relatively reliable for your own calculations as an outsider that tries to assess liquidity of a bank from publicly available data. Finally, what we can see is how this liquidity coverage ratio evolves with time, and whether this particular methodology was accurate in previous years as well. So here, the same calculations are undertaken for 2018, so 2018 annual report. Here we can see that HQLA of Barclays throughout 2019 have actually dropped quite a bit. So it means their stock of liquid assets is much lower now than it used to be. However, their net outflows have also decreased. It means that Barclays is probably slowly adjusting to the requirements of the Basel Committee for Banking Supervision, and tries to figure out what is the optimal mix of the two to guarantee the smooth functionality of their business without too many restrictions, and also to qualify for the mandatory value of 100% LCR without any issues. We can see here that the liquidity coverage ratio calculated with proxies in 2018 was 174%, which is even closer than the one we obtained for 2019 to the actual reported value of 169%. Again, reinforcing the accuracy of this methodology overall. And that's all there is for the liquidity coverage ratio and how you can calculate it using publicly available data from your favorite bank's annual report. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for business, economics, or finance videos you would like me to record. And please don't forget to subscribe to our channel or consider supporting us on Patreon. Thank you very much, and stay tuned.